Welcome to Raw and Refined, the Gentleman's Hour, where we're going to have conversation with middle-aged black men about what's going on. We welcome you to listen, comment, and like, and hopefully encourage others to join for future conversations as well. We always like to start off with a toast, and with that toast, it's because we are gentlemen and we do it raw and refined.
So we're gonna like officially get into this, and we always start off with with a toast, with a beverage. I have my standard standby, which is a Hendrix and tonic.
Right.
That's all right. That's all right. I'm coming with the holiday quaff, we will say. A good old just strawberry margarita celebrating the Mexican or Hispanic side of the holidays at this time.
Feliz Navidad.
That's right. Feliz Navidad. There you go.
Well, keeping the Mexican theme going, I've got mezcal, and this particular brand is 400 Cornejos, and it's one of the first mezcals that I ever had that turned me on to mezcal. So, and I've got one of the things I love about mezcal that you use the cool little like glass, but it's not really a shot glass. It's really It's got a cross at the bottom. It actually is what in the Catholic Church they used to put candles in. But the funny part at the bottom with the cross is when I went to Oaxaca, they said you have to drink it until you see Jesus because the Christ is at the cross.
Did you ever see him?
Hey,
Yeah.
after a
Saying,
few
was he a
shots of
black
that
man?
Cornell,
Appears that you found Jesus or the devil first if you got it.
Right.
So for me, gentlemen, I'm in my cut phase right now. So you see
Okay.
this is me finishing off my gallon of water for the day. So
My man.
good
That's
job.
all right. That's good. That's good, Anthony. I like that. That's right.
yeah,
What?
I
That's
got to
why I
get a
see.
better set of friends.
Oh,
Being bad
say
influences. I'm
right,
feeling all bad
right.
now. I got.
I'm not, because I see Anthony at the gym pretty much 3-4 times a week, and I was there earlier today. So I got it in. So I'm gonna get it in.
All right.
Today was a cardio day. So I
Yeah.
did 40 minutes on the elliptical,
Nice.
and
Excellent.
then I jumped up on the monkey bars and did leg, foot raises or whatever. Bring your feet up to your face type of deal.
Uh-huh.
I did a set of those. So I'm good. Yeah.
Man,
So
this holiday season been
there
rough
you
for
go,
my
brother.
liver.
Mhm.
This is the pound gain time. Mugs will be good for the whole year, and then over the holidays, put
Right.
on 4.5 pounds. You do that for a
Right.
decade, and you like, damn, how did I gain 40 pounds? And it's like, well, it's that each holiday slip, man. I'll do it every year. Get your eggnog on. So, welcome back to Raw and Refined. Today's episode is for the everyday working person. That's who we look at and holler at all the time as regular brothers on every level of life, right? The folks who show up every day, punch the clock, handle the responsibilities, and still feel like they're falling behind financially. I think in today's world, money is on everybody's mind. We don't get real political on this show because, it could easily turn into a podcast just about politics. We're talking about a lot of other stuff, but there's no way to avoid the realities of the current administration and the impact that it's had on the everyday and the fairly well-off person's pocket. Right? There are some people that are recession proof, but I don't know how many of them are listening to our podcast.
Right.
So we talking to the people that are listening to our podcast.
Amen.
Right? We're talking about, a lot of people. The reality is according to some of the numbers that I saw, we could realistically and reasonably say that right now, about 35 to 40% of black men in America make more than $60,000 a year. 35 to 40%, somewhere in there. So that means that more than half of brothers are making less than $60,000 a year. Somewhere between 55 and 60% of black men in America make less than $60,000 a year. And the reason that those numbers aren't hard and fast exact is because most of the number cutoffs they look at are 50,000 and 75,000, right? When you get to 75,000, it's around 28%. When you're at 50,000, we're at around 48%. So it's close. Best guesstimates looking at 60,000 is somewhere around that 35 to 40% of brothers are at that threat. So that's where we're working at today. We're saying if you're making less than 60,000 and you've ever thought investing isn't really for me, we're gonna shift that mindset some hopefully today. Now, if you're making more than $60,000 a year, that's cool too, because Anthony, our guest today, Anthony Williams, he likes to help people at all kinds of levels of money, right? Because making money don't care how much money you got, it's how much money you end up with, because we're going to work it the right way. We're not talking get rich quick schemes. We're talking about understanding the basics and realities of money. Before we got going today, Anthony and I were talking about expertise, the importance of expertise, right? I got experts on the screen. I'm looking at 3 experts. I got a medical expert. I got an expert in GK. What's the best way to describe your expertise?
Probably labor and employment.
It's more than just labor, though. You're a connector. You're a social connector. Yeah, and not a politician, though. So, we want to keep that clear. And then Anthony is a financial advisor, amongst other things. And so, expertise, the importance of expertise. I go to the doctor for my medicals. Flat out. We were talking about, your car, right? I'll change a light bulb. I'll change it flat. But when the fuel injector's tripping, I only know that because I took to the mechanic and he told me about it, right? I didn't know what was going on. The check engine light came on, right? Now I'm going to take it to the experts. So that's what we're doing today. We're joined today by Anthony Wood. Anthony is a financial advisor. He works with all kinds of people. I've known him for about 15 years. I met him when we first both worked for a company that owned several for-profit colleges and universities. I was an academic, and he was a campus president. Now we're both members at the same health club, so I see him all the time putting in work on his temple, just like he has been on his pockets and his clients' pockets. So, but more important than all of that, he's an Illini. That's right.
You're doing so well there.
Right.
Before we get into the nuts and bolts and everything, man, tell us a little bit about yourself, your background, how you got into helping people grow their loot. And what shaped your approach?
Sure. Thank you guys for having me on here. I grew up a child of blue collar workers, right? Mom and dad worked and did the best that they could. And, speaking of ILL, going to college initially and realizing that nobody in my family knows anything about finances, right? In terms of the financial aid process, I can remember a group of brothers that we all came from Mount Carmel High School, and we as thick as thieves, right? Just like you guys. And we grew up like that. And we get to our senior year and we get this letter like, wait a minute, you mean these refund checks? We've been borrowing money all of this time? We didn't know. And no one in our families, respectively, the 4 of us, our family, they couldn't tell us, right? So part of me getting into finance down at U of I was in part militant young brother. I got to take this back to the hood. I got to help everybody in the hood. So when they start to go to college and as they start to make financing decisions, they at least have some ability to know what they should do and what they shouldn't do. A lot of that comes from, for me, at age 12, my mom's a single parent. My mom passes at 12, unexpectedly, asthma attack, right? So there are no leading indicators or anything. Just June 12th, 1992 comes and life is different, right? And through that, you start to, it forces you to grow up a little bit sooner than you probably would have, but thankfully I had a grandmother and an aunt that took me and my older brother, and we were already in a 3-flat that the family owned. So not like we had to get uprooted and move somewhere. But, as you started to get older, I realized how much of a strain that put on my grandmother and my aunt. My grandmother at that point, she had raised her 6 kids, and here she is, she's supposed to retire. And now she's got to put 2 other kids through private school. And the crazy thing, man, my grandmother never made more than $40,000 a year. And she would get
Mm.
up every morning at 5 a.m. I'd smell bacon on, and she's getting ready to walk down to the bus on 69th Street to go to the Daily Center. Mount Carmel, by no stretch of the imagination, was cheap high school. And back then, they wasn't giving away all of the basketball and everything else scholarships
Mhm.
that they doing right now. So that's cold hard money. Her and my aunt, they paying to send two of us there. And it really made me say, all right, we have to do better, right? And it really made me look at, my mom, some of the decisions she made, and unfortunately, some that she thought she had more time to make, right? And ultimately, that didn't happen. My mom died on a Thursday. My grandmother and my auntie had to be back at work that Monday, so they didn't even have the time to be able to really take off and deal with the grief. Not to mention that, the financing came from the family. There was no life insurance or anything around. So these are things that for me, I saw, you kind of the bully punched first, right? You get
Mhm.
hit, and it forced me to pay attention and say, okay, Black folk, we in control of some of this. We can do better. We can run some of the plays that some of the other people are doing. We just have to be proactive, and we have to make decisions while we're still in position to be able to impact the decisions that we.
So I'm gonna hit you with one of these. So out of left field, were there any early money mistakes you made that still stick with you today?
Yes, lending money to family.
Mm. Mhm.
Rich talk about the time where, we were working together at CEC. So for me, I'm coming right out of college, and you guys can't tell I'm a talker, I'm an extrovert, serial extrovert, so I do relatively well in this company. And I start to really move up the ranks. And at that point, for Rich, there's me and my best friend, Lawrence, right? Another brother that we're doing well. Couple of mistakes was I'm an early investor in Tesla. I'm talking
Mm.
as soon as Tesla gets the first plant in Chicago, I'm young, I'm making more money than my aunts, my grandmother
Mm.
ever saw. I'm getting a nice bonus check. And I said, you know what? I got $10,000 on the side. Let me go put this in Tesla. Gotta put this in Tesla. Your family sometimes, if you don't have, sometimes we don't know when to say no, or
Mhm.
there are all type of different circumstances, different situations. So at this point, my oldest brother, God rest his soul, he's still in the streets, back and forth in the streets, and he gets himself in a situation to where he's in jail. And my aunts and my grandmother, they're devastated. They are absolutely devastated. And now it always goes. My youngest aunt come to me like, hey, you got to get him out of jail. This is gonna kill mama. She's dying watching him in jail. So I literally have to go cash in every cent of that stock that I own,
Mm.
go get him out of jail.
Mm.
Wow.
Wow.
And these are patterns that, maybe not that same situation, but these are things. It's kind of like sometimes, you know, there's always that wind that's blowing out of nowhere. So even though you're doing well and you're kind of the one that made it, unfortunately, there's always a lot of people that I can't say my grandmama, she did everything that she could for us. I can't, in my head, I can't sit there and watch her going through it. It's kind of like,
Mhm.
I got to go do this
Mm.
just for somebody to turn around and get in trouble again. To where it's kind of like, man, this was a nest egg that the whole family, we would be good
Mm.
off of what I had. And when I made that purchase, we would
Yeah.
be good. Unfortunately, that was one of the things that smacked you in the face. And another one was just working young and being ashamed to ask some of the other individuals, what are y'all doing? So again, we're the two youngest presidents in the organization. And at that point, it's about 92 different schools. And we got some other buddies that when I tell you they rolling, they rolling. We making good money, but they making real, real good money. And just having that shame of asking them, like, what are y'all doing? Because we're not doing what y'all doing. And it's kind of like, I'm not saying we spending it all on gym shoes and everything else,
Mm-hmm.
but we certainly at that age didn't know, like, hey, we should have this money diversified and it should be a little bit here, a little bit here, a little bit here, and let this work for us and so on and so forth. To where with us, you can look out 2-3 years and you really don't have anything to show for it, because between what everybody needed and what you done, that's gone.
Right. Right. Life be life, and brother. So
And
you're
it's
right. Things
expensive.
come up, and
That's
you know,
right.
you got to pivot when you can, and being blessed that you can. That's the part of that as well too. You probably helped them out, much more than they realize, through
Yeah.
all of that as well. I don't know if they ever, at least said thank you, but
Yeah.
that's the other part of when, talking about giving
Yeah.
money, in
Yeah.
That's
times of
like a
need.
Motley Fool. That's like a Motley Fool infographic, though. And I'm thinking about from when you first purchased the stock to where it would be in 2025. How they had those infographics that show the 1,700% increase or something crazy like that. Wow.
That stock was $18 when I first
Yeah,
purchased.
yeah, that's what I'm saying.
Wow.
No, that would have been one of those like 300,000% increases. To
Wow.
have that.
Kind of like, and just having that shame, right?
Mhm.
And at the same time, not trying to beat my brother up at the time, and like, dude,
Right. Right.
what you just cost us.
Wow.
Well, one of the things that I know, Anthony, that's appreciate that in this conversation. I think Hollis alluded to it a little bit, and it's particularly in this economy. Inflation. This really has been a really challenging time in the economy for a bunch of people, especially for Black folks. You slice out Black women and sort of the massive cuts in jobs for Black women. I imagine that it's something similar for Black men. We haven't seen that real data, but my hunch is Black women sort of are the sort of leading indicators of real challenges around the economy. But it says to me that, you know, thinking about financial literacy, engaging with financial advisors for folks who are sort of going, paycheck to paycheck or month to month. I don't even say paycheck to pay, like who don't really see the utility of a financial advisor given sort of the uncertainty in the economy and so forth. What would you say to sort of an everyday person who might be dealing with the stresses of this economy and the insecurity about it? Working class folks, what's the value in engaging for them with a financial advisor?
That's a great question. So one thing that you'll generally hear me refer to is a financial planner as opposed to an advisor, and I'll tell you why. I think advisors are generally your traditional wirehouses and things of that nature, that they only want to talk to you about advising on some form of an investment, right? And people will quote to you all the time, like, well, historically, the last 40 years, the S&P 500 has brought back 10%. And if you stop and you pause there for a second, what does that really mean? Right. And so for me, how our minds are wired to think that if I had $1 million and I put that into the S&P 500, I would make $100,000 a year. And that's just not the reality. And I think a lot of people having these conversations, they know that, and they know how people think that we could be down 37% one year and then go up. It's all type of ways to make that average. It doesn't mean that end number is the same. In addition, you have places that you don't have $250,000. They don't want to work for you. They don't want to work with you. You're not their target base. And I think that's more of your traditional advisor. For me, I take an approach more so holistic. We can meet whomever wherever they're at, right? Which sometimes that means this is somebody that, hey, I got to help you get some insurance, right? And fundamentally, we believe there's a 4-step process, and the sequence in which you do things matter. No one wants to talk about insurance because it's not sexy. But I tell you what, it's protection, and it's a protection that we all have to have. It just happens to be cheaper the younger you are and the better shape that you're in, right? You want to have that. Oh, by the way, depending on what type you get, it also builds cash equity, just like a home, that if done appropriately, you can borrow against tax free. Most people don't understand that. You like my uncles, old school boys from the South, and they thought, son, something happened to me. I'm not buying all that insurance for your auntie. She a good looking woman. I'm not giving
You'll
it.
be all right.
They didn't understand that it's called life insurance because it's for life. There's a living benefit associated with that you can borrow and leverage against. Oh, by the way, this is how a lot of the companies that you see out there finance some of their operations. They go pull the cash value out of their insurance, right? But we always want to start with blind spots. What are the things that you don't see? Something I don't even sell is an umbrella policy. Not sure about you guys, but Lord knows Miss Williams has a nice amount of Amazon packages that come here daily. We got snow outside. That Amazon guy slip and fall. What's picking that up? You can easily go get $1 million of coverage through your auto insure for an umbrella policy. Someone can't come after your personal assets. You got this other thing that kicks into play. But literally, we always want to approach risk protection. Then we want to put people in good habits to become world-class savers. A good saver is someone that can generally save 15 to 20% long-term. It don't mean you start there today. We want to get you into good habits. And unlike those traditional White House people to where it's transactional and you meet with them once, I'm like a coach, baby. It's like we getting together 3-4 times a year. We go see where we at. And it's my responsibility to challenge you, push you, make sure we checking stuff off the list, and just be there to be a guide for you. Once we can save, now we can get to the fun stuff. We can get to figuring out what assets we should be buying and so on and so forth. And finally, for Black folk, the last step is paying down debt and making sure we're not paying too much in retirement. We sometimes want to pay down our debt first. The sequence in terms of how you do things matter. I want you to build up enough assets that it's spitting back passive income that ultimately it will pay down the debt for you. So if you ask me with people on a constrained income, the first thing I would say, we have to learn how to save. I'm real big on I'm trying to help us build generational wealth, but in order to do that, we have to break some of the generational curses. The first thing that I see from us, and this was my case, my family couldn't tell me what to do and what not to do with money. So as I went to corporate America, one of the things I knew was I need a 401k. I need to start dumping as much in there as I could. What I didn't understand at that time was this is a great bucket of money. Long term is probably going to be your biggest bucket of money, but you can't touch that until you're 60 without some penalty. So where I give advice to a lot of individuals now, before you start to max the 401k out, let's make sure we got 3 to 6 months saved up in a liquid account that you can go put in a high yield savings account or money market account. You're going to make some interest off of it. But as the wind blows the wrong way, or in my case, if as your brother gets in a situation, you got a place that you can pull from without having to go completely obliterate your brokerage account or pull something from a 401k to where you getting hit over the head 3 different times, right? If you realize it or not. But the first thing is save. We want to put good saving habits to where you can start to save money, which for most people is creating a separate account and having your check or at least a portion to go to someplace else automatically where you don't have to think about saving. You've already made that decision. Because if not, what happens is we tend to, everything comes into the account, we fund our lifestyle from it, and then we have the stuff in our lifestyle that wasn't a budgeted line item in there. Man, that Target, Starbucks, Amazon starts to add up. And before you know it, what you thought you were going to have left over to move over to the savings account, it disappeared. Oh, I'll do it again next month. It never comes.
Anthony, you are breaking it down real well, my brother, and I appreciate the basics. But I got to take us back just for a quick moment. So I'm young. I'm trying to figure this thing out. I mean, how do I find somebody like you? What should I be looking for, and how do I even go about that part of it?
Well, that's a great question. Yeah,
Yeah.
because we ain't got a million listeners yet, so some of them gonna have to go somewhere else. They can't all come to you from this show.
Right, right.
They can. But so for me, I'm on social media, but I think you want to interview as many people as you possibly can. A lot of times for me, my client base comes from referrals. So it was me starting out building from scratch and then starting to get a little bit more sophisticated in terms of how I market to attract the people that I was looking for. Quickly what you realize, like, hey, you can set the market. I want people that makes $500,000 or more. The big part of me doing what I do was I authentically wanted to be able to help us. So I try to put myself wherever, whether it's at events or BNI events or chamber things to where people can find me. But I think you want to interview as many people as possible until you find someone that you have a great relationship with. The moment you meet someone, if they start pitching you on a product, you probably want to run away, because what I'll tell you up front, I want to learn more about you. I don't
Hmm.
even know if I can help you based off of what you're telling me. Now, most people you can help, but I want to learn about you, what's important for you, what's your goals. This is not a one size fits all model to where you can just apply to each and every individual. The four of us on this phone will have very different things that we want to accomplish, and you want someone that wants to listen, hear you out, and ultimately they're going to do what's in your best interest, as opposed to someone that just wants to quote you, hey, I can get you 10% back. Yeah, but it's a haircut on that 10%. What no one wants to tell you is that 10% is a gross number. You're going to have an investment fee that's anywhere from 1 to 1.5%. When you factor in the taxes, that's probably another, anywhere from 2 to 3% based off of how long you held it. So, that 10% number real quickly turns into 5 to 6%, but no one's quoting you a nominal number. I want to make sure you understand the full schematics of how these things work. And there are a number of us out there, so there are different little organizations in Illinois that financial planners and advisors can join just to establish more of a presence and help people. But man, we do a lot of outreach, and the biggest thing is really finding the people that want your help. With that,
Hmm.
there's the understanding that in order to find the optimal stream, you go through some turbulent waters, but you got to keep dialing, keep making LinkedIn connections and all of those things. And once you do a good job with someone, those people refer you. And that's what you want to become. You want to become serially referable.
Would you say, are there any certifications that we may need to be looking for to say, okay, this person has some knowledge and legit versus, oh yeah, Papa and Uncle went over to this dude and it looks like they did some stuff, but he don't really have any qualifications to back this up. And with that, are there like certain fees that we may need to be at least thinking about as we get engaged with somebody to help us with this finance thing?
Man, great question. So, yes, you want someone that's fully licensed. Fully licensed meaning they've got a life and health insurance license. They've got securities essential license. They've got a Series 6 or 7, Series 63, 65, 66. And those just give you the spectrum to be able to do everything that a client wants, whether it's individual stocks, whether it's ETFs, whether it's mutual fund, so on and so forth. Specifically, I'll tell you a big one out there to really pay attention to. It's called, and you guys have probably heard of it, it's called IUL insurance policy, Index Universal Life. Okay. There's also a variable universal life. So anything with variable in it, you have to be security licensed because you're investing in an underlying asset. Index Universal Life, for whatever reason, has skirted underneath the rule to where you can just have a life insurance license and be able to sell that, even though it's tied to an index. And a lot of times there are a lot of individuals, no fault of their own, but they're selling these things to people and they don't fully understand how the chassis work. What do you mean by that? It's a policy that the price increases yearly as you age, right? And you have these underlying costs. So it can build equity, but the costs go up annually to where you can get to a point where it erodes all of the equity. So it's got a real bad name. And in part, I don't necessarily think the issue is with the product. I think it's with the lack of legislation that anybody with a life insurance policy can sell an IUL, but to go sell a VUL, no, you got to have a Series 6 and a 63. You got to be securities
Okay.
licensed, and they're pretty close to being one and the same.
Excellent.
Good questions.
Yeah. Thanks, John. So let's start with some of the basics. When people hear stocks, what does that actually mean? Let's get all the way basic. I understand what it is because of my legal background, but let's go at it from the financial background. Break that down for us, Anthony. What does that mean? What is a stock?
So literally, it's a piece of ownership in a corporation, right? And it's literally just an ownership claim that, we start a company, and whether we take it publicly or not, one sheet of paper entitles me to one share of stock within that organization. The reason you want stocks is because stocks historically have outpaced inflation, right? So if you look at something like an Apple, when it came to be, it is like 3,000 times in front of where the inflation rate. So stocks are great for what we call capital appreciation. Capital appreciation really just means, hey, as the company performs well, it does well, that stock price is going to go up at a further rate than where inflation moves. So it's the biggest single mover of capital accumulation out of all of the securities out there.
So now, those of us who still watch the news from time to time, whether or not, I think pretty much anybody working has some connection to the market. Not that we understand what that connection is.
Right.
Obviously, we know that the market isn't necessarily telling us whether the economy is good. Sometimes people confuse that. Economy could be terrible, market could be doing fantastic, right? But can you talk a little bit about, so when the news says the market is down, right? Or the market is up for that matter, what does that really mean?
Sure. So a good way to think about it is if we just had a basket of goods, and if we just said the only thing in this basket of goods was apples and bananas, what's the cost, or more importantly, what's the value of apples and bananas, that combination at any point in time? So primarily in the US, when the market is up or down, we're comparing it to a indices, right? And primarily that's the S&P 500, which is based off of the 500 biggest companies in the United States, and it's looking at what's the valuation of all of those companies, and is that up or is that down? Now, if we get anybody that's in economics, what's truly intriguing is what moves the price up or down is the volume, right? So it's the demand of this basket of goods. If we have more people that want to buy, the prices go up. If we have more people that want to sell, the prices go down. That's what's going to move it. Now you get all type of governmental data leading and lagging
Indicators or whatever.
indicators that should be moving it. But then you get to sometimes to where it's like, hey, the market is up and we can't really explain why the market is up. Right now, you start to look at jobless data, inflation, even though they're telling us inflation is down, but CPI, cost of food, you have a lot of things, and not just this year, probably the last 5 years, that would suggest the market should be down, but the market is at an all-time high right now. Part of that is you got 7 companies that really do business with each other that are at all-time highs. So the market is at an all-time high.
I think I recall irrational exuberance or something back in the 90s. They used to say it, refer to it as that.
Yeah. So this AI thing is very intriguing to watch. You go down the rabbit hole. I'm not sure if any of you guys follow Michael Burry, the guy from The Big Short that predicted the housing crisis back in the day and made like a couple of $1 billion because he saw stuff from the stock charts that nobody else could see. Well, he just made a $1 billion bet maybe about a month ago on AI. Like, this thing is oversaturated, and you start to see some of the threads starting to come loose. And as great as we think AI is, they're having a hard time finding revenue growth that correspond with AI. So it's almost like this recirculation of funding between these 7 organizations.
Isn't China starting to regulate their AI to start to say, we're going to start basically weaning people out, because they're concerned now is we're going to get a lot
Bubble.
You're not going to have any innovation. You just got all these same people that's creating all the same little whack ass chatbots everywhere, right?
Yeah. So you were talking about it earlier with doing some work to try to break the models. I think and this is a whole different topic. One of the things we got to be real conscientious of and think people have put so much faith and hope off of AI. You got companies laying off thousands of people, and you can't point to $1 of revenue growth from AI. In addition, you start to look at somebody has to program that. Black man, I started to say, all right, I'm gonna talk to me about slavery, because I want to see what the chatbot brings me back on that. And that's where you start to realize, like, hey, these things, they're still being fed information from somebody, and that's what's into the programming. So you still very much need the human element. There are people
and it's not the programming, it's the training.
Yep.
It's the training of the AI, and who's training it, how they're training it.
I had
training. Go ahead.
No, I read something about definitely going down a rabbit hole a little bit, but the way in which AI is even able to drive is like this proliferation of data centers, right? That's needed to sometimes, and there's this whole industry around data centers that are going to be left dormant because it ain't going to be any use for them, and how much water and electricity these data centers use, and how we're not even thinking about
proliferation of small nuclear plants that are going to be built for all of this kind of stuff. But yeah, we'll go way down the rabbit hole and end up popping out on the other side of the planet.
Yeah.
That's a whole discussion topic. AI.
It is.
What is it? What it means?
We're going to get to that. But for right now, talk to me about how bonds are different from stocks and why do they matter. I think I have a pretty basic understanding. Like you said, stocks are ownership, bonds are loans.
Yeah.
Right? You're lending money to a company, a bond. With a stock, you're buying a piece of the company.
Sure.
Right.
You're spot on with that. So a bond is literally, a stock is a ownership, a bond is a debt obligation. So in essence, right now we hear a lot of stuff about the cost of borrowing, the cost of money, right? Bonds have an inverse relationship with interest rates. As interest rates go up, cost of bonds tend to go down. It's cheaper to borrow at that point. But with a bond, it says, Rich, if you starting a company and you want to raise capital, you can issue a bond to me, and they're usually sold in $1,000 denominations, and there's a coupon rate saying, okay, I'll pay you 5% interest, which bonds pay interest semi-annually, so twice a year. So it may be 5%, which means, okay, we go give you $25 twice a year. So it equates to that 5% off of that coupon rate. But with a bond, you have no votership, right? Because it's just a debt. It's an obligation. So when people talk about the United States being in trouble with all of these places because we have so much outstanding bond obligations that are out there, to where semi-annually or with treasuries annually, we have to make these debt payments back on top of the original amount. Whereas the stock can appreciate in value. You can get a stock at $50 and, within a year or two, that stock could be at $500. That's never going to be the case with a bond. You go buy a bond at a discount or a premium and you go get your stated interest rate and that's it, right? Once you get to the end of that 10, 20, or 30-year period, they go give you your $1,000 back, and that interest that you get every year, that was just a part of it, right? Pay taxes on.
So that being said, Anthony, with bonds, I think of it as stocks as like and forgive me if this doesn't fit some folks' status quo, but your Mercedes, your BMWs are like the stocks. That's yeah, that looks good. I like how that's going and everything. And bonds are like your Fords. They just sturdy. They're gonna be there and they're gonna kind of do and get you a little bit. What would you recommend? If again, I'm just a guy just trying to figure this out a little bit, trying to put some money somewhere, trying to earn a little bit. When should I start maybe thinking about bond investment? Is that early or maybe a little bit later in this path?
So, me personally, I would tell you a little bit later. And the reason being, I would step back and I would say, we talk 401ks, right?
Mm-hmm.
So we say 401ks. Generally, how your 401k works is it's set up in what they call a target date fund. So what a target date fund is it attempts to figure out what year you're going to retire, what year you turn 65, and it matches an asset allocation based off of that. When I say asset allocation, it's looking at what percentage should be in equities or stocks, which are more aggressive, and what percentage should be in bonds. So for instance, a target date fund, it starts with the number 100 and it subtracts your age. Say for instance, I'm 45. 100 minus 45, that fund would say, hey, you should be at 55% equities and you should be 45% in safe or stable money, which is bonds. Me personally, my ideology on that is it's way too conservative and you leave too much on the table. I truly believe that, you probably want to stay high in equities with the understanding that it's volatile, but the more time we have something invested, as we stretch it out, it looks like an accordion that's kind of, or a series of steps going up with the understanding there going to be some short term pullback, but long term, I think you do better in more equities. And what you're always trying to figure out is what year are we retiring at, right?
Okay, because see, now that's why I'm 57, right? So, creeping up there a little bit there. You're not blessed to be able to retire anytime real soon, but still start thinking about those shifting things, right? You're saying I should be aggressive, but when should you start to pull back? I know in recent years we've seen some of these situations where, like, well, for one, COVID came in and dropped a big old bag of crap on everybody. And so a lot of people lost a lot of money in their funds and things of that nature. And so some would say, well, now I can't retire in 3 years like I had planned to. Now I'm going to have to keep working for a few more years. So could something like that be, how can you kind of mitigate some of that as you're, planning for this?
So I think, the closer you get to retirement, that's where you definitely want to start to really pay attention to what that mix is. Now, for me, what my answer would be is I would tell you want three things. You want a balanced structure. And with the balanced structure, you want one bucket of money that's variable growth, meaning that is in the market long term. That's going to be your biggest bucket of money. You want another bucket of money that is pension money, right? So think about that as Social Security, so on and so forth, right? And then you want another bucket of money that's just true liquidity. Hey, I've saved this and this is where we get to that. If we have those three buckets of money, my job is I'm always trying to figure out, are you retiring in 2008 or are you retiring in 2023? What does that mean? Well, 2023, the market is up roughly 23.55%. 2008, the market is down 38%, right? So the traditional thought has been, you live on this 4% retirement rule, meaning that out of the variable bucket, you can pull out 4%. Well, that's assuming that the market is always up, right? You in 2008 and you got $1 million that's supposed to last you for the next 30 years, and you see an immediate hit of 38%, timeout, start over, do over. If that's all we have, that's a big problem. I want you to have, and how we structure things with our clients is, I want you to have all three of these buckets. And the reason being is when 2008 hit, I'm not telling you to pull out of the market. I'm telling you to stay in the market, because guess what? The next year it went back up 23. The next year it went further back up. We just have, you want to work with someone that has the faith and that's going to coach you and push you like, hey, stay in there. But I need you to have another bucket of money that we can pull from in the event when the market is down, right? And long term, Ernst & Young did a great study that people that have more than just their variable money, that has some true liquidity that they've saved up, which, by the way, you can do a lot of forced savings with a life insurance policy or equity that you have in your home, and so on and so forth, that you can access in the event that it's a down market, allowing that variable account to raise back up. Those people seldomly run out of money that have more than one source. If you only have that one source, you're tied to how the market's going to move, which on average, we know 2 out of 10 years, the market is going to go down. Just generally what it does. But Rich, back to your original question, I think, people that have a high sensitivity to the market and how it's going, it makes sense to start to get a little bit more conservative the closer you get to retirement. If you don't have those other buckets and you can't stomach that, we get closer to retirement, we should be pretty close to a 50-50 blend between safe money and money in the market, to where you're not subjected to it. Flip side I see is a lot of people that, right now they're too aggressive to it, to where they're showing these huge retirement shortfalls. And it's kind of like, hey, we can generally easily make this up by going a little bit more aggressive right now. And, as we do that, we take some of it, we put it to the side, and we get a little bit more conservative long term as we need to. But strategies out there for everyone. But if it's only that one bucket of money, we definitely want to start to get conservative, especially if people can't stomach seeing it go down. April, right? April of this year, the market was down at 1.13%. And these same cats that we at the health club with, man, they corner me, they talk to me.
Freaking out.
The worst thing in the world that you can do when you see it drop like that is to go panic sell. A lot of these guys in retirement, they went in panic sold. And what happened 2 weeks later? It shot back up 20%, right? Regardless of what people think, a lot of people made a lot of money since Liberation Day. You know what I mean? So
Yeah.
you want to be able to have a wherewithal and have the confidence of somebody telling you, hey, this happens, this is going to come back up. But if you sell at the bottom, you can never recoup that loss. That's the only point. So timing is of the utmost important, unfortunately.
And that's where expertise comes in, because you need to deal with the nerves, the emotion, the panic that the average person, and because one of the things we've seen in the last few years, right, is with all of the different ways, and we haven't even talked crypto or anything like that, but in the last several years, we finally reached a point where the average person can invest, right? I remember when incremental investing really didn't happen, when you had to be able to buy 100 shares to get some stock, right? Now you can buy 10% of a share from 10 different places. So you got a lot more people who are jumping in who don't necessarily understand the things that you're talking about the way that clearly you understand them. So, there's a lot of new risk. Go ahead, Greg.
One of the themes I'm sort of already hearing throughout a lot of that, what you're saying, Anthony, has to do with like patience, long-term thinking, and having a strategy, which of course was something that we all sort of struggle with, because we Americans, we want instant gratification. And there's nothing more gratifying than gold. And so one of the things I would love to hear you talk about from a financial perspective is gold. And it's just as expensive as it's ever been, but is it particularly valuable? And like, as an investor, how would you even think about gold?
So, disclaimer, me individually, I am all in on gold and silver. This is not tied to any empirical training or anything like that. a huge advocate. Every time Costco send out and say that they got some of them bars in there, all over it. Same thing with silver. I think silver is, sometimes we look at the big thing that's moving, and usually the real opportunity is the thing that kind of that little stepchild that's sitting right there that's kind of like, this is moving a little bit too, and people aren't. But for me, it's more so it's a precious commodity, and I think through whatever happens with currency, gold is always something that you can melt down and you can trade regardless of who's the dominant entity or country that's in power. So I'm always an advocate of we can never have too much gold or precious metal. And that's just my perspective tied to nothing. But again, every time Costco run one of them promotions and they got them gold bars in there, I'm trying to load the truck up and get as many of them as I can to put in the safe deposit box because that's not going anywhere.
That's kind of like I've always said with respect to real estate. The reality is the earth every day has more people. I mean, we haven't yet really developed a way to build more land, right? Real estate is forever more precious. And technologically, yeah, we are starting to build islands and little things and cute little stuff like that. But until we really reach the point where we can move big chunks of people to another planet, space is always going to be ever more scarce. And so there are certain things, like you said, this is gold. It's a precious commodity. We already know that people like stuff that's precious, right? There's a very small percentage of this Earth population that truly lives communally, and that truly everybody else wants their stuff for themselves, which makes prices go up. Let's jump on down to some first time investing on a limited income. Let's say someone only has, I'm going to actually turn this into a two-part question, Anthony, because I do want to touch on something that was mentioned that I saw a little earlier, and that was index funds is something for new investors. But if you've got somebody that only has about $25 or $50 a month, is that even worth investing? What is the deal with index funds? I know people say that that's often a good thing for somebody that's starting out to look at.
Sure. Question one, with the $25 to $50, what I would actually encourage that person to do, because you're trying to build those good habits, I would encourage them to put that into a high yield savings account and continue to save up. And I would tell them, like, hey, you set the target to where we get X amount in there, then we go make an investment, right? Usually whether that's 5,000 or 2,500, but yes, because for me, long term, mathematically, we can prove out that the amount you can save is more important than the rate of return on what you save, right?
Got you.
As I can build that habit in you, we can closely get where you need to get, and then we can start to invest that. We get to $500, then let's go get a fund, so on and so forth. But long term, I want to build that ability to save, because if I teach you to save and you fully buy into that, you got a limitless future. And the second part of that with the index fund. So an index fund is, Warren Buffett swears by these for the average investor, and I'm a big proponent of it. An index fund is something that's passively managed, and what it is it's a replica of an index, right? So for me, I like to find things that are replicas of the S&P 500. You can't physically go by the S&P 500 because it doesn't exist. However, Vanguard and BlackRock and these big companies, they'll go and they'll attempt to replicate these funds. And with the passive fund, generally it's a lower expense ratio, and it's more tied to the number return that you see in the market for more so, as opposed to someone that comes to you and says, John, I can beat the market and I'm going to charge you blah, 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 blah. There are some people that can, right? But on average, the S&P 500, you're not stuck watching the stock market every day. And the reason you're not stuck is because it's a replica of the 500 biggest companies. As something underperforms, they kick it out and they add something else new in there that's performing where it should be, right? So it's a passive strategy, whereas an active strategy would think of a day trader, man, I got to go sell it. Well, then that's all about timing, right? You got to know what the right time, just because it's going up don't mean it's the time to buy. You may have missed the entry point, right? So the passive investment is a great way. My actual strategy that I used for myself coming up was I bought as much as I could in these passively managed funds, right? Just to accumulate money. And they were tracking the market more often than not. So it was a good way to start to really get exposed to investing. And then as you get a little bit better, you start to step out and get into a little bit more complex strategies. But something where you starting out, I think it's a great way. Once you start to, you got a little bit of money you saved up that you can invest. Go find you an index fund and track that and see how you perform.
Now, Anthony, I don't know if I'm just a little slow, a little ignorant, a little old or whatever, but we talking index fund. Is that similar to what I used to think of as mutual funds, or are those two different concepts there?
So index fund more often than not.
I'm sorry. He did ask that question like he was 73, didn't he?
Right. I'm like, what?
Didn't you expect him to start like
Yeah,
chewing
like,
on some
what?
chaw or
What?
something?
So index fund more often than not is within the mutual fund family. So that's usually what you're buying into. Mutual funds do tend to have someone that's actively managing the account, which means that hey, so your 401ks, you guys look at what's investing in your 401ks. If you do, if you don't, you'll see something in there that's usually says iShares. iShares are usually the index account. You might see something like the Russell 2000 or Vanguard, blah blah blah. iShares, that's a replica of either the S&P or the Dow Jones, based off of whichever you track it. But yes, it's within the mutual fund family. And again, they got someone in there, if something underperforms, they kicking it out and bringing it back in there. So the thing with the index fund is nothing for you to do. It's called a passive strategy, right? Because you don't have to go in there and watch and figure out what's doing well, what's not doing well. It's taking an average of all of this stuff, and that's how you figure out how well you're performing.
Now, with that, again, I got a little money here. I'm like, all right, I think I'm ready to jump in this thing. But, whoo, Anthony, how you gonna help me out with? Man, I don't want to lose this money though either. So, how you gonna help me through that?
Yeah, I think there's always so one of the first things you want to do whenever you start to talk about investing, you do an investor profile on the individual, right? So for us, we have this thing. I'm a fiduciary, which means that by obligation and law, I have to do what's in the best interest of you, not what's in the best interest of me. So we do a risk profile and questionnaire. And based off of that, that gives us a recommended portfolio. So from there, I'm just showing you several things that fit into there. Now, anyone that tells you like, hey, we guaranteeing you that this won't go down or this won't go up, you run away from them as fast as you can and make sure there ain't no horns you see on top of their head and everything else, because that's not accurate. But here's the thing. One of the ways I'm compensated, anything that I'm managing is generally a 1% fee that's standard in the sector. And for you, that's a good thing. But the reason it's a good thing is obviously I want that 1% to grow. You want that 1% to grow, because as that 1% grows for me, that means that component of yours that I have under management is also growing. So as you do better, I do better. But with that, based off your risk profile, we hedge. We figure out what makes the most sense. A lot of times I'm a advocate of a blended portfolio. So think of a pizza, think of a large pizza, right? And it's figuring out what asset classes should we have in there, right? To counterbalance each other. One may be large cap, big stocks. You might have some international markets in there. You may have, some private equity in there or whatnot. But the whole concept from that is to kind of balance everything out to where we can get a predictable return based off of your risk profile.
Excellent, my friend. Excellent. That sounds like a good Italian fiesta right there for me.
Man, it's the same size pizza. It's just figuring out who getting the bigger slice and from where.
That's right. That's right.
Excellent. All right, I got another question along those lines. Doing these basics. IRAs, you talked about a 401k. All right, so what, difference? What's an IRA versus 1K, and then what's a Roth IRA versus a traditional IRA? Because I've heard both of those, and I have one, and I'm not sure. I got to go back and look and see which one I got.
We need to look, especially as you start to get closer to retirement. So 1K is usually a work sponsored plan to where you contribute some money pre-tax. You can do it pre-tax or after. There are companies now that are starting to do Roth 401ks as well, which is traditional 401k is pre-tax dollars, meaning you pay the taxes when you start to pull money out. The Roth IRA, those contributions I put on there after an after-tax basis, which means that grows tax deferred. You're not paying taxes on that any further. But with a 401k, you're capped at putting 23. So these really became prevalent once companies in the United States moved away from these guaranteed pensions. It was the United States way of helping people to fund their savings. An IRA, on by contrast, is an individual retirement account. So you can put money in there. Now, one of the things with the 401k and the IRA, and I'll get back to the difference in a second, both of those you have to have earnings. Okay? Meaning you have to have wages that contribute in order to put that money in there. I can't just be someone that's not working and contribute to a 401k or an IRA, right? So with the
So if I'm slinging rocks on the side, I can't put that in my IRA.
No, sir.
That's jacked up.
No, sir.
They're just putting it out there. We don't know who's listening to the
Or 403B.
our audience.
Or
We're trying to help out Pookie too.
Right. But yeah, that's a huge defining characteristic of the 401k and IRA. You have to earn wages. So you have to have W-2 income that you can show in order to be able to invest into those accounts.
So if you're just a business owner and you
so there are different types as a business that you can open for our audience. You know, 401k you got to show wages or earnings from your employer. And with your 401k, the good thing is a lot of times your company will give you a match on there, whereas the IRA is an individual retirement account, so it's funded by you individually, and it's a much smaller amount that you can put in there. So this year you can put $7,000 in there per year, Roth. So if you can afford to put into the Roth account, I'm a huge advocate, contribute to Roth, because Roth you're contributing on an after-tax basis, which means that's going to grow tax deferred. You're not paying taxes on anything that you put in there, and it gives you more flexibility in terms of withdrawing and everything else. Now, I'm still a huge advocate. You want to not touch that bucket of money into retirement, but you have way more flexibility on a Roth account than you do on a traditional account. The Roths, there is a income cutoff for the Roth, right? That's how powerful of a tool it is. Einstein, one of his things is compound interest is the eighth wonder of the world. And with the Roth account, you really start to see that work because you don't have that financial term. We like to use the word haircut, right? You don't have that haircut that's coming off for taxes and things of that nature as you get to the end. So, Rich, even going back to something you said earlier, part of my strategy as we start to get closer to retirement, when we got a runway, if you tell me, hey, 65, this is it, you know, we start to get closer to 60, we start to take a look at, all right, how much variable money or how much money do we have that's 401k money or IRA money that's pre-taxes? I don't want you to have this ongoing relationship with the tax man. So we want to start to take portions of that to where we pay taxes up probably over the next 5 years or so. So by the time you get to retirement, we're done with that. We've paid that. So as those accounts continue to grow and build, that's now tax deferred. You don't have to worry about the tax man any further on that. So, you know, we often say, I often ask people, you know, do you think more people get injured going up Mount Everest or coming down Mount Everest? And, you know, it's not even close. It's coming down. Well, your retirement strategy, you can go to a traditional broker house, wire house, or whomever. Everybody looks the same going up the mountain. You care about coming down the mountain because you want to make sure that I've got enough income in the event that I live too long. See, when we going up the mountain, we're worried about if we die too young. Coming down is if I live too long. What happens if I get some sort of a illness to where the money machine turns off going up? Well, coming down is kind of like, hey, I don't want to have to sell all of my assets if I got some sort of a long-term disability or so just to get Medicaid to be able to go to a nursing home or so, right? Taxes going up the mountain, we can put everything in pre-tax, right? So it's great then. Coming down, now you got someone that's saying, oh, you got $2 million you didn't save. That's great. 35% of that come back to me, right? So we want to have those strategies like, hey, how do we mitigate all of that? So my focus is really on educating and preparing people as we start to come down that mountain, so we not spending too much time looking down at them steps and we trip going down that mountain, which is what we find disproportionately happen with people coming down Mount Everest, or it's not going up, coming down to where it's problematic.
Really, really, really powerful stuff. The going down and up the mountain is counterintuitive as heck, right? But
Yeah.
I'm seeing the imagery. As soon as you said it, I'm like, yeah, most people get jacked up coming down the mountain.
Yeah, it's coming down.
Because by the way, going up, you stop before it gets too heavy, right?
Yeah. Coming down, it's like, wait a minute, see that? Didn't know that? Wait, where did that come from, right? Less time to make adjustments coming down than going up.
Right. Everything's speeding up. Whoa, it's coming so fast.
There you go. Right. Gravity's at full work coming down.
Wow. It's a powerful metaphor.
You just see the picture, and people see the picture, and they like, woo, okay.
Exactly.
So let's shift a little bit to talk about budgeting. Budgeting, debt, and retirement. So budgeting, I'll speak for myself, and I will admit this and say that budgeting often feels like punishment instead of empowerment. How should people rethink budgeting?
Figure out what you can save. I will tell you, at the Williams household and with the people that I work with, I am not going to tell Ms. Williams, you need to budget this and that, but we're going to commit to a pile of money. I don't want to get too much into your lifestyle and everything else, but we want to, when we get to a point to where we can save 15 to 20%. So take a step back. You brought up retirement. What does retirement look like? What do you need to retire? The average person, and don't take this as, this is a rule of law. Take this as no different than going to the doctor. Jay, you can attest to this, that, it's saying 120 over 80 is a uniformly accepted practice for what good blood pressure looks like. So treat this the same way, right? The average person generally wants to live off of 80% of their 5 highest earning years in retirement, meaning they don't want their lifestyle to deviate too far away from where it was. And keep in mind, them last 5 years are typically the highest earning years, right? How do we get there? So it's almost reverse engineering mathematically. How do we get there? Well, the way you get there is optimally you want to be able to save 15 to 20% of your income that we can put in play into assets that are going to generate more passive income to where it affords you the ability to completely walk away from work. That's generally the formula of what you need in order to be able to retire. To get there, you got to be a world-class saver. That's why the question that you asked with that person that only had $25 to $50, that's such a great question, because in our head, we generally want to make things to where we, unfortunately, I'm not as smart as John. John's a MD. That's just the reality of it. And in this game, you don't have to be, right? You want to have good habits. So that kid that can save that $25 to $50 up front, that I can easily grow that 1 to 2% a year. By the time they're 5 years into it, if you start to think about it, that's a big number that they're able to save that doesn't feel like anything. People get annual raises, right? And my thought process was, man, you get 4% annual raise, start to split the difference. Here's the reality. People generally get a 4% raise. How much do you think their spending goes up?
That's absolutely true.
4%.
Double.
Now, here's the reality. Over a 30-year time frame, if your salary goes up 4%, I'm intelligent enough to know you're going to spend something. If I can constrain you at just allowing your spending to go up 3% as opposed to that full 4%, over a 30-year time frame, what we're able to do with what you're able to save becomes baffling.
Mm.
Something else we don't think about. We like to think sometimes of ourselves as just an asset that my negotiated salary is $200,000 a year. So I think of myself as a $200,000 asset. That's not how the marketplace sees you. The marketplace looks at you, and we have to look at ourselves a lot like commercial real estate. Commercial real estate, an appraiser would look at us as a asset that spits out $200,000 a year over the next 20 years that's compounding at, somewhere between 3 and 4%. So the marketplace would see us as about a $4 million asset. Doesn't mean they would give us a loan for $4 million. They would figure out what's the net present value, meaning what's that worth in today's dollar. Oh, well, that's maybe worth $1.8 million. We have to start to think about ourselves like that, because long term, if we never get another large raise or promotion and we just stick to that 3 to 4% growth, those numbers become astronomically larger than where we're at. So my goal is always, how do I protect that from you in the event that the money machine stops today? Yeah. Like, let me put a strategy in place to make sure that this is going to come through your balance sheet regardless. So saving, again, just in that illustration, the ability to constrain that saving at 3% instead of 4%, that will trump rate of return. So the question becomes, imagine if I could get you to save, to only spend that 3%, and then I could show you a net return, not a gross return, a net return of 5%. Now that number gets really, really, really bigger. So you always want to have protection first. Once protection is taken care of, you ain't got to touch it no more. Optimal saving, and that's what puts us in line for retirement. Hell, at that point, we might be able to have conversations of, man, you can retire a little bit earlier if you want to.
This sounds like another podcast, and that is bringing our sons back, our young people back, to hear what you just said. Because I'm like, damn it, why didn't I know this 30 years ago?
Right.
Yeah.
Right.
Yeah. Well, I fall into a different category, man. I fall into the, I kind of knew, but I did a whole bunch of stupid stuff along the way, and so I didn't really take full advantage. But you hit the nail on the head, man. I'll bring the sons, nephews back on, and let's make sure that we get them on that right foot at that age where they can still really, take advantage of the mathematics. Because, at 57, the mathematics is a lot different than 27, right? Compound interest over 30 years, that's right there. That's that 30 years. So,
we just showed them, hey, you put this $6,000 while you can afford to into a Roth IRA, and if we can get you a net return of 8%, 21 years, you're a millionaire. 21 years, you're a millionaire.
Right. So I would have already been one a decade ago,
Yep.
We won't. That's who we want. But the traditional people, they don't want to touch them. I want them because I know long term, you go have more stuff. Your family's going to change. But truly, when you think about us and who we impact, this is how we start to reshape us and our present here. Yeah. We can get them in better position.
So if I could just ask this one question, I know we're getting toward the end here, because I think a lot about, the moment that we're in, given the struggles around the economy, concerns around employment, and I think you know this better than I do, the way that debt is playing out in the country. Gas bills are high and electricity is high. So people have very little, or they will say that they have very little sort of money to spend on investing, or they have nothing to save, right? How do you respond to that? Like, what advice would you give to people who are sort of even dealing with this question of how do you save in the midst of all of the craziness going on.
So what I would do, I challenge them and I give them a budget worksheet. And usually when you give people a budget worksheet, people are conscientious of what their top line expenses are. It's those small idiosyncrasies that they don't realize. They don't understand how much Starbucks creep up. They don't understand how much Amazon creep up or how much going to lunch for XYZ. And, I give them that and it don't matter how much money you make. Most people have no clue how much money is going to what this bucket I call lifestyle of living your best life, right? Until they go through and look at it like, damn, I didn't realize I had this much money. A joke, a mentor of mine told me, money is like water, right? If you're not careful where you putting it, it's going to evaporate. It's going to dry up and it's all going to be gone. And the other question, once you have people to go through that exercise, it's beneficial for them to go through that exercise just for them to see where their money is going. But the other part then becomes, so if you do nothing different, how does this story change? Right. And I think you always want to take bite-sized steps. That's the easiest way to eat an elephant. If somebody tells me they can only put up $25, I'm not showing them a strategy to where they should be putting up $300, right? It's let's figure out how to get this to 30. And I'm going, again, my role is to be a coach with you because the benefit in this for me is it's a long-term relationship with you, right? As things change, you'd be amazed at how many people turn their head up. They won't work with somebody because they're not their target client, and that person ends up winning the lottery or getting an inheritance or something like that. They don't want to deal with you because you treated them like crap. But I fundamentally believe if you can teach good habits and if we can raise people up to the bar, we're not lowering the bar down for you. We're going to get you to the bar and we go give you a strategy to how you get to 30 and we go give you some more time and then we go figure out how to get to 60 and so on and so forth. I feel like I've had a huge impact on your life to where you now have this skill set that the average person doesn't have. You have this discipline in terms of, hey, I can cut some stuff out to get to where I want to be because the reality, we tend to think as we make more money, we're going to do better with money. And that is one of the biggest fallacies that exist out there. Again, most people, their average increase is 4%. You spend 4% more. Me just showing you on a graph, like, hey, if we can constrain this at 3%, look at what this delta and your wealth building truly looks like. It's the same thing starting out. With those people, it tends to be a little bit easier with someone that's not making a lot of money as opposed to someone that is making a lot of money, because the ones that's making a lot of money and not saving a lot, generally you got every excuse in the world, whereas someone else, they almost feel as though my back is, what do I have to lose? And when you can show them, like, we can get to a point real quick to where life looks dramatically different. So I think there's always a way, but it starts with, let's take a look at your budget. You do your budget, and then let's get together and let's figure out where our areas of opportunity are at within this budget. And again, most people will find there are some discretionary things in there that, because everything's going to that main checking account, you're not even conscientious of how prevalent that spending is in those respective buckets. And before you know it, you might have 7 to 8% spend in this bucket, and you saying I can't save anything. Right there, Starbucks. They getting it.
Thank you for that.
Building wealth is like trying to maintain health. It's a pathway that if you don't understand it, it's going to be very hard for you to get to the point where you're going to feel good about it. And I think Anthony has been dropping some golden nuggets,
some gems, some golden
with the gold right now, right at this time. And I don't know how the fellas feel, but this may be a good point for us to kind of come to a close.
We've touched on a lot of things. We've also left space for the reality that there's a lot more for us to talk about. So we know we're already going to be planning to ask you back. All our listeners out there who've had the pleasure of listening to this brother educate us today, well, hit us with your questions. What thoughts did this conversation spark for you? What else would you like for Anthony to cover? Just hit us up, let us know, and we'll make sure to include that when we come back around. For everybody here at Raw and Refined, and for Anthony Williams, thank you, brother. Appreciate you so much. Everybody, take care. Have a great rest
Thank
of
you,
your day.
Anthony.
Appreciate you, brothers, and I'm coming back whenever, man. I had a good time. I feel like this time then flew by, like I'm just sitting here talking with the brothers, just having a regular conversation.
That's it right
That's
there.
the goal. That's the goal.